Somebody in your life told you that renting is throwing your money straight into a landlord's pocket. Maybe it was your father. Maybe it was a coworker who just closed on their first house and will not stop talking about it. And somebody else, maybe a friend who reads too much finance content online, told you the exact opposite, that buying a house is a trap, that you're better off renting forever and investing the difference in the stock market. Here's the problem: they cannot both be right. And the uncomfortable truth neither one of them wants to admit is that they are both wrong. Because whether you rent or whether you buy, there is a number. An exact, calculable number, quietly draining cash out of your bank account every single month. Money you are never, ever getting back. Today I'm handing you the exact formula real estate analysts use behind closed doors. By the end of this video, you'll be able to calculate, down to the dollar, whether renting or buying is the smarter move for your life. And stick with me until the end, because I'm going to show you something hidden inside a 50-year-old mortgage from 1976 that will change the way you think about debt forever. Before we go any further, if this is your first time here, hit that subscribe button right now. On David Marshall Finance, we take the money questions that keep you up at 3 in the morning, and we answer them with real numbers, not opinions. Subscribe now because you do not want to miss what is coming in this video. I'm David Marshall. Some of you already know me. For those who don't, I spent years as a financial analyst, staring at spreadsheets that most people never get to see, the ones banks and real estate firms use internally to make their own decisions. And somewhere along the way, I got obsessed with a simple question. Why does nobody explain money the way it actually works? Not the sanitized version you get from a real estate agent trying to sell you a house. Not the panic-driven version you get from social media telling you home ownership is a scam. The real math. The numbers underneath the numbers. That is what this channel is built on. And today we are tackling one of the oldest arguments in personal finance: renting versus buying. For decades, the advice has been almost religious. Renting is throwing money away, buying builds equity. You've heard it so many times it probably feels like a law of physics rather than an opinion, and I understand why it feels true. When you rent, you write a check every month, and at the end of the year you have exactly $0 of ownership to show for it. When you buy, every mortgage payment chips away at a loan balance, and slowly that number climbs towards something that is legally completely yours. On the surface, it looks like buying wins every single time. But here is the sentence that's going to bother you for the rest of this video. Owning a home does not mean every dollar you spend is building wealth. In fact, a huge percentage of what a homeowner pays every single month evaporates just as completely as rent does. It pays for things that have nothing to do with equity. Property taxes, insurance, maintenance, repairs, interest, and the invisible cost of tying up hundreds of thousands of dollars in an asset that historically does not grow anywhere near as fast as people assume. So if you are a renter who has been made to feel foolish at every family dinner for not owning a home, I want you to actually listen to this video because the math is going to surprise you. And if you're a proud homeowner who has been smugly telling your renting friends they are wasting their money, I want you to listen too, because you are about to find out exactly how much of your own mortgage payment is quietly disappearing into thin air, never to be seen again. Here is the concept that changes everything, and once you understand it, you will never look at a mortgage statement or a lease agreement the same way again. It's called an unrecoverable cost. An unrecoverable cost is any dollar you spend that you will never get back in any form. Not as equity, not as an asset, not as a future return, just gone. And here is the part almost nobody talks about. Both renting and buying have unrecoverable costs. Both options have money you will never see again. Renters understand this instinctively. Every dollar of rent is unrecoverable. That part is obvious. But what shocks most homeowners is just how much of their own monthly mortgage payment falls into that exact same bucket. Property taxes gone, homeowners insurance gone. Routine maintenance and repairs gone. And the biggest one of all, the cost of the capital you have tied up in that house, also gone. So the real question was never renting versus buying in some abstract moral sense. The real question is which option has a smaller unrecoverable cost for your specific situation. And to answer that with precision instead of gut feeling, I built something I'm calling the 8.71% rule. It's inspired by a simpler version popularized by Canadian finance educator Ben Felix, sometimes called the 5% rule. But today I'm going to walk you through the complete version, with every single cost included, so you can run this exact calculation on any house you're considering right now. Let's start with the first unrecoverable cost of owning a home: property taxes. Across the United States, the average property tax rate sits at 1.11% of your home's value every single year. That number swings wildly depending on where you live. If you're in New Jersey, brace yourself, you're closer to 2%. If you're in Hawaii, you're paying next to nothing. But for our national example, we're using that average of 1.11%. Let's put a real number on this. Say you buy a $500,000 home. 1.11% of $500,000 comes out to $5,500 a year in property taxes. That's roughly $458 every single month gone forever the moment you pay it. You will never get that money back when you sell the house. It does not build equity. It does not appreciate. It simply funds your local school district, your roads, and your fire department, whether you like it or not. And notice something important here. Rent already includes an implicit version of this cost because your landlord is paying property tax on the building you live in and folding that expense into your monthly rent. So property tax is not a reason to avoid buying. It is simply one of the pieces of the puzzle we need to count honestly. Now here's the second unrecoverable cost, and it's the one most first-time buyers dramatically underestimate: maintenance. The standard rule of thumb used by real estate professionals is that a home costs about 1% of its value every single year just to keep it functioning properly. New roof, water heater, HVAC repairs, plumbing, termite damage nobody saw coming. On that same $500,000 home, 1% works out to $5,000 a year, or a little over $416 a month. And here's the trap. Many new homeowners budget for their mortgage payment and completely forget this number exists until the exact month their air conditioning dies in July and they're suddenly staring at a $6,000 bill they never planned for. Renters, on the other hand, do not pay this cost directly. If the water heater breaks in your rental, you call your landlord, not a contractor. But again, just like property taxes, this cost is quietly baked into your rent price. Your landlord is not running a charity. They're pricing maintenance risk directly into what you pay them every month. Now we get to the third unrecoverable cost, and this is the one that changes the entire conversation because it's the one almost nobody calculates correctly: the cost of capital. When you buy a home, you're not just taking out a loan. You are also locking up a huge amount of your own cash as a down payment, and that cash could have been doing something else. It could have been invested. This is called the opportunity cost of your down payment, and it might be the single most ignored number in the entire renting versus buying debate. Here's the historical data. Over the last 30 years, the S&P 500 has delivered an average real return, meaning after inflation, of about 7.19% per year. Real estate over that same 30-year window has delivered a real return of only about 1.97% per year. That is the gap between stock market returns and home appreciation, and it is massive. A gap of roughly 5 percentage points every single year. So when you take 20% of a $500,000 home, which is $100,000, and you lock it up as a down payment instead of investing it in the market, you're giving up that 5% premium on $100,000. That's $5,000 a year in pure opportunity cost. Money that isn't stolen from you, but money you never get to earn because it's frozen inside your house instead of compounding in an index fund. But we're not done. There's a second half to the cost of capital, and it's the one everyone already knows about: the interest you pay on your mortgage, sometimes called the cost of debt. On the remaining 80% of that $500,000 home, that's $400,000 borrowed at a typical mortgage rate. The interest cost alone adds up to a significant chunk every single year. When you combine the opportunity cost of your down payment with the cost of debt on your loan, the entire cost of capital comes out to approximately 6.6% of the home's value every single year. Not 1%, not 2%, 6.6%. This is by far the largest unrecoverable cost of owning a home, larger than taxes and maintenance combined several times over. And almost nobody accounts for it when they proudly tell you that renting is throwing money away. So let's put the entire picture together, because this is the moment everything clicks into place. Add up the three unrecoverable costs of owning a home. Property taxes at 1.11%, maintenance at 1.00%, and the cost of capital at 6.6%. Add those three numbers together and you get 8.71%. That is the 8.71% rule. 8.71% of your home's value every single year is money that disappears completely, regardless of whether the home appreciates in value or not. Now here's how you turn that percentage into something useful. Take your home's purchase price, multiply it by 8.71%, and divide the result by 12. That gives you your break-even monthly rent. The number that tells you exactly how much rent you'd need to be paying on a comparable home before buying actually becomes the better mathematical decision. Let's run this on a real number: a $400,000 home. Multiply $400,000 by 8.71% and you get $34,840 a year. Divide that by 12 months and you land on $2,903 a month. That's it. That's the number. If you can rent a comparable home in the same neighborhood for less than $2,903 a month, renting is mathematically the superior financial decision. Not emotionally, not culturally, mathematically. And if rent on a comparable place is higher than $2,903, buying starts pulling ahead. This is the formula real estate professionals quietly run in their heads before every single purchase, and now you have it too. Let me show you what this looks like with two people. Ryan and Megan both live in the same city in the same style of neighborhood. Ryan buys a $400,000 home. Megan rents a nearly identical house 2 streets over for $2,400 a month. Using our formula, Ryan's unrecoverable cost is $2,903 a month. Megan is paying $503 less every single month than the true, hidden cost of ownership. Over just 1 year, that's over $6,000 in Megan's pocket that Ryan is quietly losing to taxes, maintenance, and the cost of capital. Ryan will tell you at every dinner party that he's building equity and Megan is throwing money away. But the number on his mortgage statement doesn't feel real to him the way rent feels real to Megan. That's the illusion. Ryan's unrecoverable cost is just as real as Megan's rent. It's simply disguised, spread out, and hidden inside a bigger, scarier-looking number called a mortgage payment. Now, before you go cancel your mortgage or rush out to sign a lease, I need to be honest with you about something critical. This formula is powerful, but it is not the whole story. There are human factors and mathematical quirks that can completely flip this conclusion depending on your personal situation. Run your own numbers, because personal circumstances trump formulas every single time. Let's break down exactly what I mean. The first flaw in the pure math is us, human beings. The 8.71% rule assumes that if you rent instead of buy, you take the money you saved on your down payment and you actually invest it consistently for decades without touching it. In reality, that almost never happens. Study after study on renter behavior shows the same pattern. The money that should have gone into an index fund gets spent on vacations, on a nicer car, on upgraded furniture, on simply living a slightly more comfortable lifestyle. The formula assumes perfect discipline. Real life rarely provides it. This is one of the strongest arguments in favor of home ownership, and it has nothing to do with property values. It has to do with human psychology. Which leads directly into the second flaw. A mortgage acts as a forced savings vehicle. Every single month, a portion of your payment goes toward paying down your loan balance, called your principal. That money is not lost like your interest or your taxes. It builds real equity dollar for dollar. And because the payment is mandatory, because the bank will foreclose on you if you skip it, homeowners end up saving money almost against their own will. Renters have to build that same discipline entirely on their own, with no external pressure forcing them to do it. For a huge percentage of Americans, that structural pressure is the difference between retiring with real assets and retiring with nothing but decades of receipts. Here's the third flaw, and it's one that catches almost every first-time buyer off guard. Mortgage interest is heavily front-loaded. If you look at your amortization schedule, the document that maps out every single payment for the life of your loan, you'll notice that in the first several years of a 30-year mortgage, the overwhelming majority of your payment goes toward interest, not principal. On a typical loan, it can take somewhere close to 20 years before the majority of your monthly payment finally starts attacking the loan balance instead of just paying interest to the bank. This means the forced savings benefit we just talked about barely exists in the early years of a mortgage. If you buy a home and sell it 3 years later, you have built almost no real equity through principal payments. Nearly everything you paid went straight into interest and unrecoverable costs, just like rent. This is exactly why real estate professionals will tell you again and again that buying a home only makes sense if you plan to stay for at least 5 to 7 years. Buy and sell too quickly, and you've essentially paid rent to a bank instead of a landlord, with extra steps and extra risk. And renting has its own hidden advantage that never shows up in any formula: flexibility. If your job relocates you, if your relationship changes, if you simply want to try living in a new city for a year, breaking a lease is inconvenient, but selling a house involves realtor commissions, closing costs, and months of uncertainty. That flexibility has real value, even if it never appears as a line item in anyone's spreadsheet. And now, the thing I promised you at the very beginning of this video, the story hidden inside a mortgage from 1976. Imagine for a moment that back in 1976, a young couple bought a modest home and somehow locked in a 50-year fixed mortgage with a monthly payment of exactly $300. In 1976, $300 was a real number. It was roughly a full week's paycheck for the average American worker. It felt substantial. It felt like a genuine sacrifice every single month. Now fast forward to today, to 2026, 50 years later. That same $300 payment is still due every single month because the mortgage is fixed. It never changed, not once. But the world around that number changed completely. Inflation quietly, relentlessly ate away at the value of the dollar for 5 straight decades. Today, $300 barely covers a single week of groceries for a small family. It's the cost of a nice dinner out. It is, for most people watching this in 2026, financially meaningless. That fixed $300 payment that once required real sacrifice has become, essentially, pocket change. This is the quiet superpower of a fixed-rate mortgage, and it's a benefit that almost nobody talks about because it happens too slowly to notice year to year. Every single year that passes, inflation shrinks the real burden of your mortgage payment, while your income, on average, rises with inflation right alongside it. Meanwhile, rent does not work this way. Rent gets renegotiated. Rent gets adjusted to match current market conditions every single year or every time your lease renews. Mortgage payments are fixed, but rent prices can rise on a whim. Your landlord is not locked into 1976 pricing. They're pricing your apartment based on this year's market and next year and every year after that for as long as you keep renting. A 30-year fixed mortgage is essentially a bet that inflation will keep happening. A bet that has won for basically every single homeowner in American history who held on long enough to see it play out. One more piece of the puzzle that trips people up: the mortgage interest deduction. For decades, this was one of the biggest selling points of home ownership, the idea that you could deduct your mortgage interest from your taxable income every single year. Here's what most people don't realize in 2026. The standard deduction, the amount every taxpayer gets automatically without itemizing anything, now sits at roughly $13,000 to $14,000 for a single filer. For the mortgage interest deduction to actually help you, your itemized deductions, including that mortgage interest, need to exceed that standard deduction amount. For a huge percentage of homeowners today, especially those with smaller mortgages or lower interest rates, that math simply doesn't clear the bar. Which means the tax benefit that your parents' generation relied on so heavily may not apply to you at all. It's not gone entirely, but it's a lot smaller and a lot less universal than most people assume. So where does this leave us? Renting is not throwing money away. Buying is not automatically building wealth. Both options have money you will never see again every single month, regardless of which one you choose. The 8.71% rule gives you a real, calculable number to compare them honestly, instead of relying on family pressure or finance influencers online with strong opinions and no spreadsheets. But the formula is a starting point, not a verdict. Your job for the next 30 seconds is simple. Look up your local property tax rate, estimate 1% of the home's value for maintenance, calculate the cost of capital based on your actual down payment and interest rate, add those three numbers together, divide by 12, and compare that number honestly to the actual rent for a comparable home in your area. Run your own numbers because personal circumstances trump formulas every single time. Your job situation, how long you plan to stay, your tolerance for maintenance headaches, your discipline as an investor, all of that matters just as much as the math. And never forget the other side of the coin either. Mortgage payments are fixed, but rent prices can rise on a whim, and that alone changes the calculation the longer you plan to stay somewhere. If this video just changed the way you think about your own rent or your own mortgage, that's exactly why this channel exists. On David Marshall Finance, we don't do hype and we don't do fear. We do the actual math, the kind that most financial advice conveniently skips over. If you want to see this same kind of breakdown applied to car loans, student debt, or how much house you can actually afford without wrecking your future, hit subscribe right now because that's exactly what's coming next. And if you made it all the way to the end of this video, drop a comment below with your own numbers. Tell me your home price or your rent, and let's see what the 8.71% rule says about your specific situation. I read every single one. I'm David Marshall, and I'll see you in the next video.